Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and things have moved even a little bit more extreme than what we spoke about here last week. So we want to talk a little bit about how we're viewing this markets and how specifically how we're positioning for it. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with looking at the equity indices and how they have continued to move to the extremes and just try to measure some of that extremity, specifically with respect to the fixed income markets and the reactions that we've seen the fixed income markets have to some of the economic indicators from last week and how that has impacted equities and just how that's stretched equities even further from what we talked about here last week. And then show you some of the commodities that have also moved that are influenced by the inflationary debate that we've been bringing up for the past month or so. And then it's important for us to look at the sector rotation model because despite the market conditions that we're in, I still believe that there are opportunities, and it's important to look at that sector rotation model to understand where those opportunities are, which sectors to pay attention to with specific names within those sectors, and how I'm looking for opportunities before showing you some of the economic indicators from last week that drove interest rates lower and then is now driving equities higher before sharing with you some of our ideas from today. But the primary question that I want to help investors answer from today's session is a question that we continue to receive, which is, are we reaching levels of complacency that suggests that we are about to see a market pullback or a market sell-off here? That's the primary question that I think is on many investors' minds. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my charts, my economic research that help inform my decisions in the broader markets and how I'm positioning for it. So let's first take a look at the S&P 500, which is on a very clear uptrend here on the weekly chart. The daily chart continues to print new higher highs and actually accelerated a bit towards the end of last week to new highs here. The daily chart has reached overbought conditions here on RSI. The weekly chart also reaching that overbought condition here. So we are seeing both the weekly and daily charts start to reach levels that suggest we are near a market top. But again, I continue to remind investors, overbought conditions can remain overbought for a long period of time. Overbought in itself is not a good reason to go out there and short the markets. It is a good reason to potentially no longer add new long positions here in the current market conditions. And it is also prudent to look for starting to start preparing for potentially some market hedges, especially as volatility continues to print new all-time lows, or rather new relative lows to the pandemic. We're starting to see some pre-pandemic volatility numbers. So buying hedges are relatively inexpensive. It's time to start thinking about hedges. It's time to start preparing for hedges. It's time to start learning about hedges if you've never put on a hedge before. These are the times to do it. But let's talk a little bit about some of the other markets before we take a look at everything on balance. When you look at the QQQs, we've managed to break out above this 340 level, continues to march on higher or melt on higher, if you will. Both the daily and weekly chart have also reached overbought conditions. So you have the same conditions here on NASDAQ as you do with the S&P 500. But the problem here is the fact that if you look at the other indices, the small cap Russell 2000 index has failed to make a new high since March. You have the same thing from the Dow Jones Industrials. You have the same problem in the Dow Jones Transports. And this is concerning when you see the S&P and NASDAQ are the only two indices making new highs, and the rest of the indices are failing to make new highs, especially if you look at emerging markets failing to make new highs. This is concerning to see because when you see markets make new all-time highs and you're thinking about adding to your long positions and continuing to remain invested, to support that decision, you want to see other indices participate on that rally. We're not seeing that. We continue to fail to see that. And we started talking about this 4 weeks ago. And the longer this goes on for, the less healthy this market rally is. But keep in mind, an unhealthy market rally can still continue to go on for weeks, sometimes months, before that corrects itself. We saw this in January and February of 2020 before the coronavirus sell-off. But all we're seeing right now are just the conditions that are necessary for a violent and spectacular sell-off. The conditions themselves do not cause that sell-off. You still need some external factor, some kind of external catalyst to drive that market lower. So what we're setting up right now is simply just the potential of another violent sell-off, but we still need that catalyst. And just the potential itself, is not really useful, because seeing the potential, this narrowing of market breadth where the RSP fails to make new highs. The S&P, this is the S&P 500 equal weight index, has not made a new high since early May. So that's, you don't want to see that when most of the S&P 500 names are not making new highs, and just a few of the mega cap names are dragging the markets higher. Same thing with the percentage of stocks trading above its 50-day moving average. Only 50% of all stocks are trading above its 50-day moving average. Think about that for a second. When you have equity indices reaching new all-time highs, you should see 70, 80% of stocks trading above its 50-day moving average. But instead, you're seeing only 50% of them trade above its 50-day moving average. Those are market internals that are fairly poor, that lead me to believe that the current breakout that we're seeing here, while it can stretch and last for quite a bit of time, the longer it lasts for, the more likely you're going to see this violent sell-off. Think about it like a rubber band. The longer it stretches out, the more spectacular that break is going to be. And that's exactly what we're seeing here right now. But again, just because you're seeing the rubber band stretch is not a good reason to say it's going to break. You still need something to break that rubber band. And that's really some of the things that we're paying attention to right now. And then when we look at the fixed income markets, we had the 10-year yields react to last week's jobs numbers, which we'll take a look at here in one moment. And I talked about this last week, where I said, if for those of you that don't necessarily want to read economic indicators and figure all that stuff out, one barometer you can use is simply just interest rates. If interest rates continue to move lower, that's the market effectively stating that they believe inflation is going to be more transitory, and that's exactly what we've seen. The job reports here last week was fairly strong, or stronger than expected. Markets reacted by interest rates moving lower. So settling the debate a little bit that the inflationary concerns are more transitory rather than permanent. That sent equity valuations higher. That sent the S&P and the NASDAQ 100 higher here. But the other half of the equation of inflation is really the goods that you and I consume. And then to look at that, you really have to look at manufacturing. You have to look at the raw material prices that go into producing those consumer goods. And some of those things that are important to look at are, for example, fuel costs. Crude on the failed OPEC meeting this morning started to rally again. So crude is now back above what is a fairly important level that I would say around 75 or so, which goes back to 2018. We're now back above this level. A breakout here above 75, 76, that targets 90 to even 110 here to the upside. A fairly significant level here in oil, considering we were back in negative territory earlier this year or late last year, and well into the 40s and 50 level here for a big part of last year. And now we're talking potentially $90, $110 on oil. Those are some of the big numbers that we have to pay attention to that go into the calculation of inflation. If gasoline gets back to $4 a gallon, that's going to impact, inflationary numbers. That's going to impact the cost of the goods that you need to purchase as those input prices are factored in to the shipping of goods. You look at gold. Gold finally found a bit of support here around $166. Gold, less so of a industrial metal, but certainly one that is in many electronics, finding some support, potentially bouncing off that 166 level. You could also look at this potentially as an inverted head and shoulders or a bottoming formation here for gold back into the 180 level, and then potentially up to 195 here to the upside. That's one way to take a look at it. But on another base metal, very important to pay attention to is copper. Copper continues to rise, and we're talking about well above multi-decade highs around $3.30 or so. We're back up to $4.30 and continuing to climb after what has been a fairly sizable correction from about 487 down to $4 or so. So sizable correction, but starting to see copper move higher from here. So a lot of the raw materials that go into our consumer goods, have seen a bit of a sell-off here over the past month or so, but are starting to rise here again. These are some of the concerns that I have on the other half of the equation with respect to inflation. So I do think that while on the employment side and the labor side, we're starting to see some easing and some strong results out of the economic indicators that lead to more a transitory inflationary concern. On the other side, I see the opposite picture, especially if you look at some of the manufacturing numbers, which we'll take a look at here in one moment. So as you look for as you understand the current market condition that we're in, which is a fairly complacent market, a market that is reaching these kind of stretched, I would say extremes, if you will, both from a valuation perspective, from a momentum perspective, from a market breadth perspective. But like I said, these stretch conditions many times can actually stretch even further. They can last many times for 2-3 months before it kind of breaks, if you will. Like I said, again, similar to the January and February 2020 markets that we saw before the coronavirus sell-off. So the thing that none of us can answer is when is that catalyst going to emerge and what that catalyst is going to be. But the longer we see this rubber band stretch, the more prepared we should be for what could be a violent and quick sell-off. So that's why it's important to understand these market conditions and understand how to trade while you're in it and how to prepare for what could be that next sell-off here. And now is the time to start thinking about put hedges. Now is the time to consider putting on a small put hedge. For those of you that are concerned that the rubber band is just about to break, for those of you that think it can stretch a little longer, or maybe you're just learning how to hedge, take the time now to learn, because you don't want to learn as the markets are starting to sell off. You don't want to be in March 2020 trying to figure out how to hedge your portfolio. You want to figure those things out now so that you're prepared for it when that kind of catalyst event starts to emerge. So one of the things that I still want to point investors to is that right now you have three sectors that are leading: healthcare, discretionary, and technology. And then you have the other 8 that are either slightly improving, lagging, or weakening. You do have 3 materials, financials, and industrials that are starting to get into that improving category. We're going to take a look at some of the names within that particular sector, as well as those sectors themselves. And then we also see technology and discretionary that are leading, but starting to move towards the weakening category. They're not quite there yet, but these are ones that we want to pay attention to. So when we look at the sectors, right, you have XLY, consumer discretionary, on Friday, breaking out to new all-time highs. But as you can see, the daily chart reaching that overbought condition. So just from a timing perspective, not a particularly great time to go long, right? Because as you can see, as these sectors trade within a channel, right now we're near the top end of the channel. Top end of the channel is not a great time to go to extend new long positions. This is the time to be more cautious. And as you see a pullback here, those are your opportunities to then establish a new long position within a bullish trend. You see the same thing here in technology. Technology making new highs, as you can see within the channel, near the upper bound of that channel. So when you're near the upper bound of this channel, it can continue to stay on the upper bound of that channel. There's no doubt about that. But you do have a higher likelihood of a pullback here, and the risk to reward here does not favor further longs. The risk to reward ratio actually favors for you to wait for a pullback, and on that pullback, then look for that long position. But that's really where industrials and some of the other sectors currently sit. So if you look at XLI, we've had the pullback here from the highs that we saw here in early May. We've pulled back, found some support, and is now starting to rise back above the 21-day moving average. And you have both industrials and financials in the same conditions where you've had the pullback, it's now rebounded off that bottom and has now bounced back above the 21-day moving average. And I think those are your better opportunities as you seek long positions in this market to look for some of the sectors that have been weakening but starting to improve. And those are the sectors or names that you want to specifically focus on, because while we identify these kind of stretch conditions, these complacent markets can remain complacent for weeks, sometimes months. It's not a good reason to go short the markets. If you are going to short the markets, you have to be very tactical. You have to be very sensitive of timing and be aware of when the trades are not going well, and cut your losses on those trades quickly. There's nothing wrong with trying to find some shorts in this market. And I do think there are some opportunities, but you need to be far more tactical. I do think in this market, you still have opportunities here to the upside. You just have to be far more selective with the sectors that you are playing. And we'll take a look at some of those names here in a second. So switching over to the economic numbers, on Friday, non-farm payrolls came out substantially stronger than expected. 720 expected new jobs came in at 850. This was after what has been a fairly weak number here in April, an improved number in May, and June has been the strongest we've seen since Q3 of last year. So job growth, very, very strong. Whether this has led to, this is because of the decline, if you will, the tapering off of federal unemployment in many states. That's largely likely what's having an effect on this, but also leisure and hospitality, which is where we've seen most of the job growth, is really what is, I think, a better part of what's contributing to the strong job numbers. As I said, the travel industry is rebounding faster than many travel stocks or travel companies had expected or were positioned for. So they're hiring faster than normal. If any of you have flown on an airline here over the past few weeks, you know that customer service, the staff on these airlines they're just not there because they did not predict air travel to come back in such a strong way. People are taking vacations. People are pent up, or what we called about pent up travel. It's happening right now, and it's happening at a pace faster than most investors and companies were expecting. So this is good that job growth has continued to be strong on both leisure and hospitality, as well as on the state and local side. This is part of why interest rates declined here last week and markets started to rally higher here. But just like as I was providing a bit of a balance using those commodity numbers, if you look at the manufacturing data, this is also where we continue to see some concerns. We've actually seen manufacturing employment plummet down to actually about 49.8. So we're back in contraction territory. So manufacturers are no longer increasing employment. They're actually starting to see a bit of contraction here in terms of employment. This speaks to just how hard it is to find proper workers for many manufacturing jobs. There's just a shortage of people capable of working, are currently out of work or seeking work at the moment, and just the pay that manufacturers have to pay to attract new workers is getting prohibitively high. This is some of the concerns that we see with inflation that are the downsides, if you will, to inflation. And on the flip side, with employment starting to contract, at the flip side, the raw material prices of what manufacturers pay to produce consumer goods continue to rise. These are some of the commodity prices I was showing you before. This is not only rising, it's continuing to rise. The expected was 87, came in at 92.1. So we continue to see this pressure on manufacturers who have not been able to find suitable workers, continue to pay more and more for consumer goods. That's going to continue to play out in the inflationary numbers, so specifically on consumer goods that you and I have to purchase every single day. So the other half of the equation, in my opinion, is the more nuanced picture when we talk about interest rates and whether inflation is transitory or permanent. It's simply not black and white like that. There's a lot of moving parts to it. So while you can use interest rates as a proxy, as a barometer for this debate, I think it's important to also dive into the underlying numbers and understand what's driving inflation, what's easing it. And for me, wage is certainly providing some easing, but on the flip side, consumer goods starting to put some pressure on inflation. So as we look for opportunities here in this market, this is really where I think you have to be very, very selective. You have to be selective on the sectors, and you have to be selective on the names within those sectors. So one name that really jumped out at me was Mohawk. This was the CNBC trade on Friday. This is our daily play here for today. Mohawk is part of the home builders index. They are one of the largest manufacturers of carpeting and flooring. We know home builders are strong. We know housing numbers remain strong here, but we've seen about almost a 25% decline here over the past month on Mohawk. So this is the opportunity that I see. Like I said, you have stocks that are near all-time highs, and then you have stocks that pull back from those all-time highs. This is one of those stocks that have pulled back, has found that support, and has the opportunity of potentially bouncing higher, where the risk reward is far more favorable for the long side than trying to buy stocks or sectors that are at their all-time highs. Mohawk, strong fundamentals. Technically speaking, I think a much better opportunity than some of the other names that are trading near all-time highs. The next one I want to take a look at is Delta Airlines. Now, I'm fairly bullish on many of the airlines, but I do think that right now you have to be very clear on financials with respect to airlines. Airlines took on a lot of debt during the coronavirus to stay afloat. And you really have to look at the names that I think have less debt and have a higher percentage of leisure travelers, if you will, to play for a quicker bounce. And this is really where Southwest Airlines and Delta stand out to me. Southwest Airlines, I actually like a little better because they focus almost entirely on leisure, and their balance sheet is, in my opinion, the strongest out of all of the airlines. But out of the legacy airlines, United American and Delta Airlines, the one that's most fiscally responsible is still Delta Airlines, the one that is still the largest airline that has, in my opinion, the fastest potential for bounce back is Delta Airlines. And technically speaking, it's trading within this range of around 40, 41 or so and 50 or so, let's call it that. And we're near the bottom of the range. And right now, what we're targeting here is a bounce back towards the top of the range. And if we do see airlines start to break below that 42 level and starts to head back down to 40, your risk to reward ratio is still favorable here because you can cut your losses as it reaches about 41 or so. And you're here risking about $3 to the downside. And then you're playing for about $6 to $7 here to the upside. That risk to reward ratio is what I'm trying to look for in any type of long opportunity here in this current market. And lastly, looking at that, the travel industry, you still have some names that are very concerning to me. Some of the cruise lines fall into this category. Airbnb certainly falls into this category. The ones that are trading at very rich valuations where the technical picture is just not lining up well for them. Airbnb finally breaking below this 170 support level, has now managed to bounce higher here and is consolidated. But this is really where I see potential further opportunity here to the downside. Airbnb, I would say near its peak from a recovery perspective. And I do think that from a valuation perspective is a little concerning here, trading at very, very rich valuations for its name. It's not profitable, and it's certainly one of the names that I think here. So you look for short opportunities. These are some of these highly levered, high valuation names that I would seek for a potential short opportunity here in the broader markets. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the broader markets and how we're currently viewing them. Like I said, we are at what I would consider a fairly it's a fairly important step in the markets right now, where we have to be clear in identifying just the lack of rotation that we're seeing from the markets, the stretch valuations, the stretch complacency that we see. Now, it's hard to say that that's a good time to short the markets because, again, history has proven itself that is in itself is not a good reason to short the markets. But it is time to start looking for those hedges, understanding some hedges. If you haven't put one on before, understand how they work so that when the rubber band does break, it could break tomorrow, it could break 3 weeks from today, that you are relatively prepared for it. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday on our next options education session. Have a great trading day.